The mid-2026 economy is locked in a standoff. Buyers refuse to overpay, and sellers refuse to discount. We are observing a macroeconomic paradox, where residential transaction volumes are visibly compressing, yet asset valuations are exhibiting robust, contrarian strength. This June 2026 market report isolates the contradiction. On the left, we see a negative 2.4% month-over-month contraction in the sales pace. On the right, the median home price defies that drop, growing by 2.2% over the same period to reach $441,000. Standard economic models operate on a simple correlation. Waning demand dictates immediate price relief. Applying that rate-sensitive predictive model to the 2026 data results in analytical failure. Standard models fail here because the market is defined by structural undersupply, a condition where severe inventory constraints entirely override interest rate sensitivity. To build a working macroeconomic model, we have to synthesize NAR housing data, totality indexes, diverging labor metrics, and recent Federal Reserve policy shifts. Transaction volumes are grinding toward a halt as structural inventory deficits maintain a firm floor under prices. To deconstruct current buyer behavior, we start by looking at the sales pace metrics from the National Association of Realtors. The data captures a distinct contraction, a 2.4% slip from 4.1 million in May down to 4.09 million in June. This short-term dip is a symptom of acute buyer sensitivity. Consumers are closely tracking mortgage rates and flinching at micro-fluctuations in borrowing costs. But assessing market health strictly through month-over-month snapshots distorts the longer-term perspective. Zooming out, the year-over-year baseline reveals that despite the monthly drop, total transactions are actually up 2.8% compared to June 2025. This points to a firm underlying current of demand. Buyers have not abandoned the market. They are holding cash on the sidelines, waiting for optimal entry points. That steady demand sits in direct conflict with severe affordability constraints, which continue to lock many first-time buyers out of the transaction cycle. Observing only month-over-month declines creates a cooling market fallacy. The reality is that year-over-year baseline demand is holding firm. The mechanical cause of the insulated price floor becomes obvious when we move down the dataset to the inventory metrics. This threshold chart highlights the deficit. A historically balanced real estate market requires approximately 6 months of available housing supply. Operating at a 4.6-month supply is a severe structural deficit. It creates an unyielding floor under asset prices. The direct symptom of this deficit is rampant competitive friction. Homes are spending just 28 days on the market, and 21% of them are still selling above list price. This split graphic cross-references the NAR median price data with the latest Totality Home Price Insights report to validate the growth trend. While slight methodological variations exist between the two indices, their shared conclusion is identical: steady asset appreciation. Totality's forward-looking models project that prices will increase another 4.8% over the next 12 months. The hard inventory floor of 1.56 million available units is the primary macroeconomic force overriding rate sensitivity. It artificially sustains the $441,000 valuation despite throttled transaction volume. The friction observed in housing extends to the broader macroeconomic picture, specifically as emerging weakness within the labor market. This dual-axis chart tracks unemployment metrics. Initial claims remain historically low, holding steady at 215,000. That low figure suggests a resilient baseline, devoid of mass systemic corporate layoffs. However, continuing unemployment claims conflict with that narrative, sitting elevated at 1.814 million. This growing delta represents search duration, the critical metric defining exactly how long it takes an unemployed worker to reabsorb into the workforce. Extended search duration confirms the job market is silently becoming much more challenging for active job seekers. Standard headline indicators fail to capture this creeping underlying labor market weakness. While workers are not being fired en masse, the prolonged friction of finding new work quietly drains consumer confidence and subtly saps future housing demand. The institutional response to these conflicting macroeconomic signals is currently being directed by Federal Reserve Chair Kevin Warsh. Warsh has deployed a new, highly specialized task force comprised of former Fed officials and central bank leaders. As this flowchart outlines, the core mandate of these 5 task forces is to completely modernize how the Fed evaluates economic conditions. The Fed is taking this step as divergent datasets, like sales dropping while prices rise, complicate the use of established evaluation frameworks. The immediate economic calendar will serve as a real-time stress test for this new macroeconomic reality. This forward watch calendar highlights Tuesday's Consumer Price Index and Wednesday's Producer Price Index as the critical inflation prints driving the Fed's next narrative. By the end of the week, market focus will shift to Friday's housing starts and building permits data. This data will reveal whether developers are finally beginning to bridge the massive 4.6-month supply gap we identified. In an economy defined by structural constraints, professionals must track continuing jobless claims and inventory deficits alongside headline sales figures to build an accurate forecast for the quarters ahead.